In the high-stakes world of Wall Street, where fortunes are made and lost in the blink of an eye, few names command the respect and admiration of traders like Paul Tudor Jones. He's the kind of figure whispered about in trading circles, his strategies studied by aspiring investors, his name etched into the annals of financial history. But what cemented his legacy as one of the greatest traders of all time? One single, legendary trade, the Black Monday bet of 1987. A trade so bold, so prescient, that it turned him into a Wall Street icon overnight. To understand this monumental moment, we must first step back and explore the man behind the trade. Early days, a natural risk-taker. Paul Tudor Jones wasn't born with a silver spoon. He wasn't handed a portfolio of blue-chip stocks as a child. Instead, he was a boy from Memphis, Tennessee, who grew up with a fascination for risk and competition. Born in 1954, Jones had an affinity for strategy games and a natural instinct for spotting opportunities. His journey to Wall Street wasn't a straight shot. In fact, he attended the University of Virginia, earning a degree in economics. But the real turning point came when he was introduced to trading by his cousin, William Donovan, a major cotton trader. That exposure sparked an interest that would shape his destiny. Jones started his career on the floor of the New York Cotton Exchange, learning the ropes of commodities trading. This was the old-school style of trading, yelling in the pits, reading market sentiment through body language, and trusting one's instincts over computer algorithms. It was chaotic, exhilarating, and full of risks, just the kind of environment Jones thrived in. Building the Tudor Empire. By the early 1980s, Jones had already made a name for himself as a rising star in commodities trading. But he wasn't satisfied with being just another trader. He had bigger ambitions. In 1980, he founded Tudor Investment Corporation, a hedge fund that would go on to become one of the most successful in history. Jones had a different approach to trading than most. He wasn't just a numbers guy, he was a master of macroeconomic trends. He studied patterns in the market, identified cycles, and combined technical analysis with an almost uncanny ability to predict economic shifts. His philosophy? The secret to being successful from a trading perspective is to have an indefatigable, undying, and unquenchable thirst for information and knowledge. And that thirst led him to one of the most remarkable predictions in financial history, the 1987 market crash. The 1987 warning signs. As the mid-1980s rolled on, Wall Street was riding high. The economy was booming, corporate profits were soaring, and stock prices were climbing to new heights. It felt like the golden era of trading. Everyone was making money and optimism was at an all-time high. But Jones wasn't buying into the euphoria. He had been carefully studying historical patterns, particularly the market crashes of 1929 and 1962. And what he saw sent chills down his spine. The stock market had been rising at an unsustainable pace, fueled by easy credit and a growing sense of invincibility among investors. It was a classic bubble forming, one that was eerily similar to the lead-up to the Great Depression. Jones started running simulations. He and his team analyzed price movements, interest rates, and market psychology. The more they looked, the clearer the picture became. The market was about to collapse. But seeing the crash coming was one thing. Profiting from it was another. And this is where Paul Tudor Jones would prove why he was in a league of his own. Paul Tudor Jones had seen the warning signs. The 1987 stock market was eerily mirroring the patterns of 1929. But recognizing a potential crash wasn't enough. He needed a strategy to capitalize on it. This was where his brilliance truly shined. Unlike many traders who bet on individual stocks, Jones played the macro game, analyzing entire markets, economic cycles, and investor psychology. He wasn't just reacting to price movements, he was anticipating them. The key indicator. A flashback to 1929. Jones and his team at Tudor Investment Corporation had been closely studying historical market data. They focused on one of the most infamous financial disasters in history, the Great Crash of 1929. What they discovered was startling. The 1987 market trajectory was almost an exact replica of what had happened in the months leading up to the 1929 crash. The speed of the rally, the investor euphoria, the overuse of leverage. Everything pointed to a catastrophic downturn. Jones was convinced. The market was on the brink of collapse. But when exactly would it happen? That was the golden question. The breakthrough, Elliott wave theory and market timing. To pinpoint when the crash would occur, Jones turned to a powerful tool. The Elliott wave theory. This theory, developed by Ralph Nelson Elliott, suggests that markets move in predictable waves, alternating between bullish and bearish trends. Jones believed that the market had reached the final phase of a major upward wave, meaning a dramatic reversal was imminent. Jones also relied heavily on market sentiment analysis. He observed that investors had become irrationally exuberant, pouring money into stocks with reckless confidence. It was a telltale sign of a bubble about to burst. By early October 1987, Jones had made his decision. It was time to act. The bet: shorting the market before the crash. Jones began aggressively short-selling stock index futures, particularly the S&P 500 futures. For those unfamiliar with short selling, here's a quick explanation. A short trade means you borrow shares or futures contracts and sell them at the current price. If the price drops, you buy them back at the lower price, return the borrowed shares, and pocket the difference as profit. If the price rises instead, you take a loss because you'll have to buy them back at a higher price. Jones was making a bold bet that the stock market was going to plummet and he would profit from the decline. But this wasn't just any trade. Jones went all in. He poured massive capital into short positions, essentially betting against the entire U.S. stock market. Many thought he was crazy. The economy was booming, stock prices were at record highs, and financial analysts were confidently predicting further growth. But Jones trusted his research. He knew something the rest of the market refused to see, and he was about to be proven right in the most dramatic way possible. By mid-October 1987, Tudor Jones was positioned for one of the biggest short trades in financial history. He had bet against the market at a time when nearly everyone else believed in an endless bull run. Then, on Friday, October 16, 1987, the first cracks began to show. The Dow Jones Industrial Average fell over 100 points. A steep drop, but nothing catastrophic. Yet, behind the scenes, the market's foundation was crumbling. Jones and his team at Tudor Investment Corporation watched with laser focus. The real collapse hadn't started yet. But it was coming. The morning of Black Monday. Then came Monday, October 19, 1987. A day that would forever be etched in Wall Street history. It started with panic. Markets opened in freefall. The Dow Jones plunged 250 points within the first hour. Selling pressure was relentless. Traders frantically tried to unload their stocks, but there were no buyers. By midday, it became clear this was no ordinary sell-off. It was a full-blown market crash. Jones sat calmly in his office watching his screens. Unlike the rest of Wall Street, which was gripped by fear, he was executing his plan to perfection. His massive short positions were now generating a fortune as stocks continued their downward spiral. By the end of the trading day, the Dow Jones had collapsed by 508 points, an unprecedented 22.6% drop in a single day. To put that into perspective, it was the equivalent of the Dow falling over 7,000 points in today's market. The financial world was in shock. The aftermath: Jones' multi-billion-dollar payday. While most investors suffered devastating losses, Tudor Jones walked away as one of the biggest winners of Black Monday. His hedge fund, Tudor Investment Corporation, had made a staggering 200% return in a matter of days. In total, Jones had personally profited hundreds of millions of dollars from the crash, a feat that cemented his reputation as a Wall Street legend. But beyond the money, what made Jones' trade so remarkable was the accuracy of his prediction. He had called the crash to the day. He had positioned himself perfectly to capitalize on the decline. And, most impressively, he had done it using a combination of historical analysis, technical indicators, and sheer intuition. It was one of the greatest trades in Wall Street history, a moment that turned Tudor Jones into an icon. A rare few saw it coming. Most traders and economists were caught completely off guard by the 1987 crash. Many lost their entire fortunes in a single day. But Jones wasn't alone in his prediction. A handful of other traders, including George Soros and Jim Simons, had also spotted the warning signs and placed strategic bets against the market. Yet, even among these elite investors, Jones' execution stood out. He didn't just predict the crash, he traded it flawlessly, maximizing his profits while minimizing risk. As the dust settled from Black Monday, the financial world scrambled to make sense of what had just happened. The worst single-day market crash in history had wiped out over $500 billion in market value, sending shockwaves through the global economy. Many hedge funds and institutional investors suffered crippling losses. Some were completely wiped out. Governments and central banks scrambled to restore confidence in the financial system. But amid the wreckage, one man stood victorious: Paul Tudor Jones. His hedge fund had not only survived the storm but had come out on top, posting a 200% return in 1987. His uncanny ability to read the markets had made him one of the richest and most respected traders of all time. What made Jones different? Looking back, why was Paul Tudor Jones able to succeed where so many others failed? The answer lies in three fundamental trading principles that he followed religiously: pattern recognition and historical analysis. While others were focused on the present, Jones studied the past. He found striking similarities between 1987 and 1929, and he trusted those historical patterns to guide his trades. Risk management and discipline. Even though Jones was making a bold bet, he wasn't reckless. He hedged his trades, ensuring that even if he was wrong, he wouldn't lose everything. His philosophy? Losers average losers. In other words, if a trade goes against you, don't double down, cut your losses, and move on. Contrarian thinking and market psychology. While the rest of the market was euphoric, Jones remained skeptical. He understood that mass hysteria, whether optimism or panic, often leads to extreme price movements. He positioned himself against the crowd, anticipating the market's inevitable correction. Jones later admitted in interviews that he didn't expect the crash to be so severe. He thought the market would drop 15% over a few months, not 22% in a single day. But that's the beauty of being on the right side of a trade. Sometimes the market moves faster than you anticipate and your gains skyrocket overnight. The long-term impact of Black Monday. The 1987 crash led to several lasting changes in financial markets. Introduction of circuit breakers. To prevent another panic-driven collapse, stock exchanges implemented circuit breakers, automatic trading halts if markets fall too quickly. Increased focus on risk management. Institutional investors became more cautious, learning from the reckless over-leveraging that contributed to the crash. Greater reliance on computerized trading. Ironically, while program trading was partly blamed for Black Monday, the crash accelerated the adoption of algorithmic trading and risk control mechanisms. For Jones, the lessons of 1987 reinforced what he already believed: markets move in cycles, history repeats itself, and the best traders are those who anticipate, not react. Paul Tudor Jones' legendary trade of 1987 didn't just make him a Wall Street icon, it cemented his status as one of the greatest traders of all time. His ability to predict market movements, manage risk, and execute bold strategies became the stuff of financial folklore. But his success didn't stop there. Unlike many traders who rise and fall with a single historic bet, Jones continued to dominate the markets for decades. His hedge fund, Tudor Investment Corporation, remained one of the most successful and influential firms in the industry. So, what can today's investors and traders learn from Paul Tudor Jones? Lesson 1: The power of studying market history. One of Jones' greatest strengths was his ability to recognize historical patterns and apply them to modern markets. In 1987, he saw eerie similarities between that year's stock market rally and the 1929 crash. Today, traders can learn from past bubbles and crashes to anticipate potential risks in the future. Markets evolve, but human psychology stays the same. Fear and greed drive price movements, and those who understand these cycles have a competitive edge. Lesson 2: Risk management is everything. Jones wasn't just a great predictor, he was also a master of risk control. He never risked too much on a single trade. He used stop-loss strategies to protect himself. He always had a plan for when to exit the market, whether he was right or wrong. This discipline is what separates successful traders from those who blow up their accounts. As Jones himself put it, the most important rule of trading is to play great defense, not great offense. In today's volatile financial landscape, risk management remains the key to long-term success. Lesson 3: The best traders are contrarians. Jones made his fortune betting against the crowd. While most investors were chasing stocks at all-time highs in 1987, he positioned himself for a crash that no one believed was coming. This contrarian approach is often where the biggest profits are made. In 2008, some investors made billions shorting subprime mortgages while everyone else believed the housing market was too big to fail. In 2020, during the COVID-19 crash, bold traders bought stocks at rock-bottom prices when fear was at its peak. The market rewards those who stay ahead of the herd rather than following it blindly. Where's Paul Tudor Jones today? Even decades after Black Monday, Paul Tudor Jones remains one of the most respected figures in finance. Though he has shifted his focus toward philanthropy in recent years, his investment firm still actively manages billions of dollars. He has also become a strong advocate for economic reform, warning about income inequality and the long-term risks of excessive government debt. And while the markets have changed dramatically since 1987 with the rise of algorithmic trading, high-frequency trading, and cryptocurrencies, the principles that made Jones successful remain as relevant as ever. Final thoughts: the making of a Wall Street legend. Paul Tudor Jones didn't just make money, he made history. His 1987 trade was more than just a financial victory, it was a masterclass in market psychology, risk management, and bold decision-making. While most investors panicked, he remained calm. While others ignored history, he studied it. While the market collapsed, he thrived. And that is why Paul Tudor Jones will always be remembered as one of Wall Street's greatest legends.